Hi, welcome back to Your Money Mindset. This is John MacGregor, guiding you to achieving lasting financial freedom and peace of mind. Hello, everyone. We have got a powerful show for you today, and I don't say that lightly, and I couldn't be timelier given the start of the new year and everything that's going on. For the sake of you and your family, their financial situation, you do not want to miss this episode, and here's why. I get your messages from all over the world, and I can just sense the fear and the concern about what's going to happen in the future. I understand. I hear you, and I feel your anguish. Let's face it, 2020 was a brutal year for a lot of people, and we're still dealing with a lot of the same issues. Despite the fact that we have a vaccine, COVID is still out there, and some say it's growing and mutating into a different virus. And here in the US, which will affect everyone in the world, we have a brand new administration that's coming in that will look to reverse all of the previous administration's economic policies, one that includes higher taxes, more regulations, and huge acceleration in government spending and borrowing. So what I wanted to do today is invite an expert, a true pro in the field of the economy and the markets, and we are extremely, extremely blessed and grateful to have him. And based on our pre-call that he and I had, what he has to say may shock you and also offer you some hope and comfort. Anthony Eichler is a senior vice president for Stonebridge Capital out of Los Angeles, California. He's the director of fixed income strategies. He's also on the investment committee. Anthony's has 30 years of experience in the investment world. And I will also add, Anthony is a very, very dear friend of mine who I worked with many years ago at another large investment firm. There is no one I know that has a better pulse on the economy and the markets than Anthony Eichler. And he didn't just gain my respect. He immediately attained it in our first conversation. I can remember it to this day. He is a world of knowledge. So we've got a ton to cover, including the sort of the historical look at the markets, what's going on today, what people should be doing going forward. We'll talk about Bitcoin, gold, real estate, certainly the stock market. Basically, we're going to cover what happened, what's happening, and what we look and what Anthony thinks is going to happen in the future. So just so thrilled to have you, Anthony. And I know you're busy, so we're just so grateful for your time. And so why don't you take a moment, Anthony, and start off with a little bit of background about you, how you got into the business, and then a little bit of background about Stonebridge Capital. Then we'll dive right into the questions. How's that sound?
Yeah, that's fantastic. John, thank you so much for having me this afternoon. And, you know, I think about 2020 as a year of change. And my background in the business is I'm a third generation Wall Street person. Both my grandparents, my father owned a brokerage firm, and I literally started out on Wall Street as a very young person filing stock certificates in a brokerage firm. Having worked, starting on the floor of the New York Stock Exchange to today, working here in Los Angeles at Stonebridge Capital, I've spent virtually my entire life talking, thinking about investing, about equities, about bonds, about economics globally and what works. So I think of 2020 as really kind of a pivoting point. And as we go in with so much uncertainty, typically when there's a lot of uncertainty, there's a lot of opportunity. And I think investors have been rightly fearful of both the pandemic. We've got a new administration. We have other parts of the world that seem unstable. And yet, you know, equity markets recovered and ended the year on a fairly solid note. So I think you kind of have to look at the stock market and look at the equity markets over the last 100 years and say, well, as a regular investor, if I just bought a basket of stocks, and when we say a basket, the market, we think the S&P 500, which are the 500 largest names, markets have averaged just under 10%, about 9.4%. And adjusted for inflation, that's about 7% real returns. And that doesn't mean certainly every year you get that 6, 7, 8, 9%, 10% in the stock market. There's a lot of volatility. I mean, you can look at starting in 1900, the market opened up at 66 and it closed December 31st, 1999 at 11,497. So you if you just had stayed invested for 100 years, you did quite well. But over that 100 years, you had the crash in 1907, you had the Second World War, 100 years ago, we had the Spanish flu in 1918. We had the crash in 29. We certainly had 31 and 32, just really brutal years. So we were able to survive all of those things and really thrive. Certainly the 1950s and 60s were strong years. And we finished the last century on a strong note, and we've kind of continued, certainly since the 2000s. We had the market break in 08 where we were down, give or take 35%. And yet we recovered those markets and finished off this last 10 years on a very strong note. But I get this question all the time. Why do stocks go up and why do stocks go down? Why are markets going up? Why should I be invested? What drives markets? And in the short run, markets are a popularity contest. But in the long run, they're a weighing business and they weigh real corporate earnings. So if we look back over that same 100 years and we looked at returns in stocks, we would have to be able to look at the returns or the growth in corporate profits. And the growth in corporate profits over the last century have averaged, adjusted for inflation, 7%, and that mirrors the return in stocks over the last 100 years.
So Anthony, if I could chime in, basically what you're saying is what drives stock market prices is basically the underlying profits of these companies. And there's a direct correlation between the profits of these companies and their stock price. Is that correct?
That's perfect. There's another way you can look at it. You can look at corporate profits as a percentage of gross domestic product. So typically 5 to 7% of gross domestic product. In 1960, we had a $500 billion economy. In 1960, it was $1 trillion. In 1970, it was 2.7 trillion. 1980, 6.4 trillion. Today, we're $22 trillion in gross domestic product. Well, 7% of that is corporate profits. So 7% of 500 billion is 35 million. 7% of 22 trillion is $1.4 trillion. So corporate profits have grown substantially over the last 50, 60 years. And the stock market has just grown over the long term to reflect that growth in corporate profits. And that's why stocks go up over long periods of time, because they reflect the growth in the economy and ultimately the growth in corporate profits.
Great. Great answer. Thank you. I want to get into your outlook for corporate profits in a minute. But before I do that, been in the business myself for 26 years now. And we've seen a lot in that time period, but this country has seen a lot in the last 250 years, right? Like you said, wars, embargoes, assassinations, attacks, flu viruses, et cetera, pandemics. Yet I still, from the day one of getting into this business 26 years ago, I still hear the same recurring statement. This time is different. This time is different. And yet we've seen just nothing but growth in the stock market for the most part over those past 26 years. How do you answer that, Anthony?
Well, there's a great book, Reminiscence of the Stock Operator. It's one of the most famous books on Wall Street. And in, I think, the first chapter, they say, everything that's happening on Wall Street today has happened before and will happen again. So people say, well, this time is different. America has constantly been the home of innovation. And so the dynamics of our economy have changed and continue to change and will continue to change through innovation. So when people say it's different this time, how to react? Yes and no. Is it different? Things aren't exactly the same, but we've seen periods of time where markets struggle. We've seen periods of time where we've had the wind at our back. But ultimately, you have to have the long-term view that our economy, as constructed, with the innovation, the free exchange of ideas, the ability for capital to move where it's most efficiently used, has helped our economy immensely for the last 200 plus years. So capital is apolitical. It's not a Republican. It's not Democratic. Capital moves around the world where it's most efficiently used. And capital has flown to the United States and been in the United States because it's a much more efficient place for money and capital to work and grow than it is in other parts of the world. We've had the stability of law and order. We've had the stability of markets and the judicial system, et cetera, that has made capital formation in the United States very appealing, not just domestically, but around the world. But when they say it's different this time, there are times when markets get extended. We saw that in March of 2000. Certainly, we had a big sell-off in 2008 with the real estate crisis. But I think when people say it's different this time, we've had different markets. There are really three markets we get. We get great markets, lousy markets, and a lot of markets in between. We don't know what order they're going to come in, but we know we get all three of those. And I think that's the best way to take a long-term view of it.
Sure. And if you look statistically, historically, the number of years, looking back the last 100 years, the number of years, up years relative to down years is significantly different, isn't it?
Yeah, well, I mean, I get the long-term average is about 73% of the time you get a positive year, but you know, we do have those difficult years and those difficult times, and that's why, you know, as an investor, you want to be prudent, and you want to try and separate emotion in the short term from, you know, really what you're trying to achieve on the long end. And you know, there's always going to be headline risk. There's always going to be, you know, some sort of potential war or potential crisis, and we don't know which one's coming next. But if we own the right things and we're secure in what we own and why we own what we own, we tend to get through those periods of time rather healthily.
Yeah. So Warren Buffett-esque, like, correct? Knowing what you own it like a business, not like something you're going to trade in and out, like a casino.
Right.
Right. So
we want to look at it from a business perspective. We certainly wouldn't start a restaurant and figure we're going to sell it next month. We're going to build a business and build a clientele and do something that we love. So you try to look at it like a business that you would own personally.
That's great. We're going to skip ahead right now, but I do want to come back to your current outlook on things. Given what you just said and the idea of owning businesses and weathering the storms and understanding that things will always be happening, no matter how good things are in the economy, there are always negative things going on. Why, in your opinion, do investors fail or struggle with their investments? I mean, we all know the Dalbar study, right? The famous Dalbar study that comes out that says the markets have done just under 10% over time, yet the average investor has realized only about a 3% rate of return. Why is that?
Well, I think it's the only business that I know where people feel very comfortable paying high prices for things. If you think about the reason you go to Costco and you see the guy walking out of Costco, and I see him too, my wife goes, and they buy this big, giant industrial size box of Tide detergent, and they can't get it in the car. And you ask them simply, why would you buy a box of detergent that big? And they look at you and they give you the look, I'm saving money, right? I'm buying I'm buying my merchandise, I'm buying great merchandise, but I'm saving money. Investors, because of fear, tend to be, and 70% of investment behavior, remember, is driven by fear. And so when markets get difficult, people get scared and they react emotionally rather than intellectually. So we're very comfortable paying for stocks. We're close to 31,000 as we sit here today, and people are comfortable buying stocks today. But if you were here 9 months ago in March when the market was under severe pressure, we were very comfortable selling stocks. And when markets are fearful, as an investor, you should be greedy. And when markets are being greedy, you should be fearful. And I think investors' biggest failure is not having a plan, not staying with a plan, and not having a good financial advisor. You know, having somebody to talk to guide you through difficult markets is so vital when things get difficult. I loved it. You and I used to talk about this, and it's such a great analogy. But back when we were in March of 2000, 2001, Coca-Cola would sell 1 billion soft drinks every day around the world. And I would tell investors, look, the market could be tough tomorrow. Coke could be down $1, but they're going to sell another 1 billion drinks around the world tomorrow and the next day. And that gives people some sort of sense of what they own. Today, that number is 1.7 billion, by the way. But it's important for investors to know that I actually own a real business. Yeah, you can see a ticker up there, it's down 50 cents, it's up 50 cents. But what is it that they do? And what is it that makes that business unique, different, and special? And is it business going to be around in 5 years? And I think as you become, see, we can't, as investors, we could go into a Porsche dealership and we could sit down in a Porsche, a brand new one. We could smell the leather. We could touch that wheel. We could feel the stick shift and we go, boy, I feel this car. But when we own stocks or we own equities like this or bonds, we can't sit in them. We can't smell them. We can't feel them. So we don't have the same attachment to them. So what I like to do is talk to investors about what they own. Oh, you own Starbucks. That's fantastic. You go every day. Starbucks has, I think the average American has 500 cups of coffee or more than 1,000 cups of coffee a day. In Europe, 500 in the US, but they only have 30 cups of coffee in a place like China annually. And how much are they going to grow globally? And you help people understand that they actually own a real operating business that has really good, unique characteristics. And if the market's down next month or the month after that, it's an opportunity to buy businesses that you really have always wanted to own, but you haven't had the opportunity. If Disney were back down to $75, $80 magically tomorrow, not $175 where it was today, how many of the people that you and I would know would say, yeah, go get me some? But it was actually there, people say, get me out. So it's that fight of your own emotional ability to see something emotionally versus to understand something intellectually. And I think the last thing is very, very important. You've never made money betting against the United States of America. Never, not once. Winston Churchill has a great quote. Americans always get it right after they've exhausted virtually every other alternative. And my father had a better one. He used to tell me, he used to say, son, there's no pessimists that live in Bel Air. Being an optimist, being optimistic about our future, and being optimistic about the opportunities that exist in the most dynamic economy in human history. And I talk to a lot of young people today, and they'll say, well, capitalism isn't good or it doesn't work. And I said, it doesn't work. I said, it is a $500 billion economy in 1960. It's $22 trillion today. We've created more wealth for more people than any other civilization in human history. So the empirical evidence is it hasn't just worked. It's worked better than any other system that's ever been tried. And you should encourage people to be optimistic about the future. We have short-term problems, there's no question. But the future is so bright for our country because our ability to innovate and our ability to think freely and free exchange of ideas creates that opportunity for not just this generation, but the coming generations.
That is so well said. Thank you very much, Anthony, for that. I think my audience needs to hear that. I think everyone needs to hear that because everyone's in doom and gloom right now. But going back to your Winston Churchill quote, I think we're almost close to exhausting all of our solutions. So we're getting close to the end there. But going back to investor sentiment and why they underperform the market, it's they buy high, they sell low, and they repeat until they're broke, right? I mean, we see that all the time. I think you use the example, suits go on sale 2 for 1, right? What do? We buy 2 suits, right. Or buy 2, get 1 free. What do? We buy the 2 suits. Yet when the market's on sale, we don't want anything to do with it. And what I've seen over my years, it, like you said, it's fear and greed. And when you break fear and greed down, what are we talking about? We're talking about human emotion. And human emotion has been the great destroyer of wealth over time. And so people like, just as you said, you own Starbucks, regardless of what's happening in the market, millions of cups of coffee are going to be sold that day, as well as Coca-Cola. So anyway, thanks so much for that. So shifting gears, Anthony, and looking at where we are today in the economy and the market, and what's your outlook for the future? And I know it may counter what a lot of people are thinking right now. That's why we appreciate having you. I do get the question a lot, is that this market's overheated. We're at an all-time high roughly. And how could it possibly go up, particularly with this new administration coming in? And we know, this isn't political, but we just know exactly what they want to do. They want to implement more burdensome regulations. They're going to raise taxes as much as they can, and then start floating money out in the form of government spending and borrowing. What is your outlook given what's going on today?
Well, I think that we talked about earlier, is it different this time? I think the one parallel that we can look to is the Spanish flu in 1918. We just come out of World War I, or we're coming out of War I, and many people don't really recognize just what a bloody mess that was for the world. I mean, 2 million French died, 2 million Germans died, but we were emerging from a very negative situation. And what followed were the Roaring '20s. If you look at this most recent, if we were sitting here a year ago today, the US economy had the lowest unemployment rate ever recorded. We also had the lowest poverty rate ever recorded. But we did not have a lot of imbalances in the economy. If you think back to '08, we had a real overheated real estate market, mortgage market. If you look back in the early '90s, we had an S&L crisis. We've had financial crises before that have driven really difficult markets and economic times. You go to the 1930s, and the market crashed in '29, and then we had the Smoot-Hawley tax bill, and then FDR raised the tax rate in the United States to 90%, which choked off economic growth. Certainly until 1943, the economy finally emerged from depression. I think this time what we saw is we went into a real correction, a real sell-off. It was self-imposed. So we decided to shut ourselves down. It wasn't imbalances in the economy. And so what you were able to see in the third quarter was a very quick recovery over 30%. So we dropped 30% and then recovered 30%. And the economy began to stabilize and grow again. And our view is very much that there's real pent-up demand coupled with some extra economic firepower. So
Anthony,
number one.
Sorry, Anthony, when you say pent-up demand, can you explain that?
Sure. There are people that have been sitting at home that can't wait to go see grandma. I have a 13-year-old daughter that says, when does Disneyland open again? I want to go. People want to go on vacation. They haven't been able to go to Hawaii, visit their parents, visit their grandparents. They haven't been able to go to the park, go out to dinner. They haven't lived it as human beings, and we're social animals. We like to be together, and we like to talk to one another, and we like company. And I think that the ability to have been locked up and not be free is going to cause people, once there's the opportunity to do so, to get on a plane, to see your parents and grandparents you haven't seen, to go to Disneyland, to go to the beach, to go out to dinner, to go to a play, to go just to live again. And I think when something has been taken away from you, and that opportunity, that door reopens for you in your life, you will never take it for granted, and you'll be excited to do it. So I think that's just the most simple point, is a little more of reversion to normalcy, with people returning to their everyday, more everyday existence, which is going to create demand on its own. That's the first point. Mm-hmm. The second point is energy. Energy costs have dropped significantly. The price per barrel for oil, when we fill up our tank, I know California, we're $1 and change more than the rest of the country because of taxes. And yet you can fill up your car and heat your home for significantly less than you could a year ago. And for people that run households, that's a real extra tax cut for every family in America. And then thirdly, we've seen interest rates at historic lows. So both businesses and individuals have been able to refinance homes, refinance businesses, cut their fixed costs down a lot. And again, that's another tax cut to the consumer. So the consumer's been home a lot, saving more. Their cost of heating their home and filling up their car is down. The cost of carry for their homes and their businesses is down, which creates lots of cash. And then you add to it a Federal Reserve that has kept interest rates low and has said emphatically they will keep them low for some time. So we believe at Stonebridge that our economy will recover next year, and that the second half of the year we're likely to see some fairly robust growth. You ask about the new administration, and we get that question a lot. I think you have to stop thinking about investing well, if there's one party in power, one group of people is optimistic and one's negative, and then the other party comes to power, and then half the country's negative and they don't want to own stocks, and then the other half does. I think that's a fool's errand. I think you have to understand that business is going to go and continue to grow regardless of who's running the government. Now, there's no question, massive government regulation and massive government taxation has never, not once in human history, resulted in robust economic growth. We know that. But it is our belief that because we've been through a pandemic and because there are still a very fragile economy at this point, that we would look for more moderation out of Washington, at least here in the short run, as we begin to recover. And it is our hope and belief that the economy and the Washington's decision to pivot, it will be a little bit less draconian than I think people are expecting right now. And I say that Yogi Berra had the great saying, predictions are tough, especially when they're about the future. So we don't want to get too hard and fast about predictions about Washington, because you simply don't know. But it's our belief that no matter who's in office, and we know who's going to be in office now, that the U.S. economy is going to grow. It's going to continue to innovate. And I certainly think there are certain sectors of the economy and certain parts that are going to see a real recovery that will be quite strong.
That's great. Why don't we get into that? God, so many nuggets there. Thank you, Anthony. I'd like to talk about what you're excited about in the economy or the market, maybe particular areas, and then concerns you have. One concern of mine is we're at almost $28 trillion in debt, and that number is not going lower anytime soon. How long can that party last? So why don't we look at what you're hopeful for versus what you're concerned about?
Well, I think one thing that it's both hope and concern would be the S&P 500, and these are the 500 largest stocks, a basket of 500 of the largest stocks in the United States. But for many investors to understand, it's what we call cap weighted. So it's not 500 stocks equally weighted. It's 500 stocks with the biggest stocks having the most weighting or value in the index. So today, 5 stocks make up 30% of the S&P 500. The other 495 stocks are the other 70%. And when you looked at the market last year, and really over the last 2 years, the market was up, let's say 17, 18% last year. But 495 stocks were only up 3%. The technology stocks did particularly well because we were locked down. They were still growing and able to grow. And it's our belief that a lot of the growth that we've seen, whether you're shopping on Amazon, having food delivered to you, using Zoom calls as we are today, that transformation of our economy, which may have happened over 8 years, may have happened in 8 months. So those particular issues, particularly in technology, are very expensive relative to the rest of the market. On the other hand, there are vast swaths of the economy and vast swaths of the S&P 500 that are attractively valued, and we're still finding things to buy, finding things we really like that have a great risk reward in front of them. So what am I concerned about versus what we see opportunity? We see opportunity in areas of the market that maybe have done okay, maybe haven't done very well, but aren't part of the really expensive areas of the market. And again, those 5 names, and you can really drill down and five or 10 more. That part of the market is expensive, but there's tremendous opportunity here domestically. And then globally, there's opportunities really in lots of different markets. The rest of the world's had a very difficult time with COVID. And as a result, you have depressed markets all over the world. We're a domestic manager, but other managers who invest globally and internationally would be able to find things that really, and we find them here, that really make a lot of sense. So that's really one thing to think about next year. What are the things that are recover? And people would say, well, are people going to get on a cruise ship again? Are people going to drive again? Energy is a fascinating area of the market to consider. So the world typically uses, all 7.5 billion of us, 100 million barrels of oil a day prior to pandemic. That number dropped to about 70 million barrels a day. And the United States, because of fracking, had become de facto the largest producer of energy in the world, both natural gas and oil. we need in the United States approximately 600 oil rigs to produce just enough energy to supply the world with the 100 million barrels a day we need. Right now, the world's using 92 million barrels, so we're not quite back to where we were or where we will be. So we're down 10% from where we were a year ago. What's interesting is our rig count. The number of rigs pumping oil in the United States has gone from 600 rigs, and we're about 223 today. So think about this long term. What has to happen as the economy globally returns to more growth? And it's going to be, we're going to need to be able to get more energy out of the ground to supply that growth. Today, China, post-pandemic, is using more energy than they were pre-pandemic right now. So you've seen recovery in China already. And what that's going to mean is getting energy back and getting energy companies back producing energy is going to be in recovery, certainly for the next year and a half. So that's one area to keep an eye on in terms of area. We've already begun to see recovery in some of the larger integrated oil names like ExxonMobil and Chevron and Royal Dutch and so on. But I think there's certainly going to be more opportunity there. And then you look for other types of energy and kind of globally and how that long-term, the energy story is certainly one area of the market. And again, we would look at things that have positive risk-reward dynamics. Certainly the consumer stocks continue to look attractive, and the pharmaceuticals look quite attractive. The pharmaceutical companies, Merck, Pfizer, Bristol Myers, Sanofi, they went into an election year, as they usually do, with pressure on them based on a lot of the political environment. And we've seen this before. Many of those stocks are trading at a really attractive risk reward in terms of earnings and dividends, and they have great fundamentals going forward. So those are just a couple of ideas that really look promising for the next year.
That's great, Anthony. Thank you. I think the overarching theme of what you just said is no matter where the economy is, where the market is, there are always opportunities. And I hear so often, well, John, the market's overvalued. It can't go any higher. We're due for a crash. And for those that are watching or listening to this, I really want to push back on that and challenge your thinking. That's just an easy way out of not looking at the market, not looking for opportunities to make money, because there are always opportunities regardless of what's happened. And Anthony just pointed some of those out. Anthony, I want to kind of go through a lightning round on just a couple of areas within the market, investment places that people talk about often. If I could just get your comments, starting with Bitcoin.
Bitcoin, blockchain has become very, very popular. A few years ago, you heard about it. Wall Street firms have embraced it. My advice to people who are thinking about blockchain, you're probably thinking about it because it's gone up a lot recently, and a lot of neighbors have it. It's very difficult to gauge for a number of reasons, and one is we don't know what the regulatory environment will look like. You don't know what central government's reaction to it is going to be. And so while there's a place for some people in their portfolio to own Bitcoin and blockchain and different coins, our advice would be to be very careful, because again, it's like trading currencies. You have to be very, very knowledgeable and very careful to understand what the dynamics are. And I caution people every day. I understand it enough to know that you should be very careful. Bonds, we didn't talk about. Interest rates are something that I would encourage investors to be very cautious on, to not own bonds. As investors know, that the further you go out in terms of maturities, the more volatility you're going to have. The economy naturally, as it recovers, interest rates will begin to rise. Mortgage rates will again begin to rise. And so that's an area of the market that certainly you need to be cautious of and aware of. The central bank will keep interest rates low on the short end, but on the long end, we would think that interest rates would begin to rise to more normal levels, and that investors should be aware of that. Those are a couple of thoughts on both Bitcoin and fixed income.
So Anthony, just to recap that on bonds, and I'm glad you brought that up. Rates are extremely low right now, as everybody knows, right? And as you see inflationary pressures start to occur on the longer maturities on the yield curve, and interest rates start rising, those people that bought bonds today are going to get crushed. Is that correct?
Well, if you've got a significant rise in interest rate, that would be correct. If you think back to the 1970s and we had those high inflation times, for some of your viewers who remember those days, what an inflationary environment looks like, and how treacherous bonds can be in environments like that. But we don't see anything like that in the short run here because we're under recovery. But clearly, investors need to be aware of what the long-term potential inflationary environment could look like. We have $28 trillion in national government debt. We have $3.6 trillion in municipal debt. We have $7 trillion on the Fed's balance sheet. We have another $1.5 trillion in student debt. And the money supply is up 25% year over year. So there's a lot of cash floating around and a lot of debt floating around. And the potential for inflation down the road is there. And there's ways you protect yourself with that. But that potential is there down the line for sure.
Absolutely, particularly with the amount of money that they'll be printing in order to pay for all of these new programs. Moving on, how about gold and just commodities in general? What's your take?
Well, I think gold has been a natural hedge to potential future inflation and the dollar weakening. You know, people look for real assets over time. Many clients have a small percentage of money in gold and real gold. If you think about gold, and I don't know if you remember talking about this, if you melted all the gold in the world, everybody's jewelry, all the gold they have, it fits in 3.5 Olympic-sized swimming pools. So there's really not that much of it. And it's very hard to get out of the ground. It tends to be in a lot of unstable environments and a lot of unstable countries, and central banks use it as a source of safety. Individuals use it as a source of safety. So there's a place in some portfolios for a small portion of gold. What's difficult is it doesn't pay a dividend, and it's not necessarily an industrial metal. Silver is a little different because silver not only is a commodity that you can keep, can be a source of value, but is also used industrial. Copper is a very interesting story long term. So a combustible engine uses 50 pounds of copper. A Tesla uses 150 pounds of copper to build an engine. And as we electrify over the next 20, 30, 40 years, we're going to use a lot more copper to fill that demand. But again, commodities, it is a supply, demand, risk, reward environment. And again, fraught with danger. We tend to, when commodities are up, we tend to pull a lot more gold and silver and oil and everything out of the ground. And then when the bust cycle happens, we stop doing it. And so you get these boom bust cycles. And again, for the average investor, trying to guess which way the cat's going to jump is very, very difficult, but always being aware of what the future looks like. Having a small position in gold in a portfolio or the GDX or an individual gold company, you certainly could make the argument that there's a position in everybody's portfolio for some of that. That could be a good protection long term if there ever is a return to inflation.
Excellent. And based on your outlook, given interest rates going up, the dollar declining, gold could be a good place. I view gold as really an insurance, as a hedge, like you said. So lastly, real estate. Now, I know that's a broad topic. We've got a lot of different types of real estate. What's your general thought on real estate?
Well, I think, if you think about real estate historically, there's two things. Where, right? Location, location, location. If you're talking about real estate in North Carolina and Austin, Texas, or you're talking about real estate in New York City and Los Angeles and some of the big cities. So first thing would be location. Where are you talking about real estate? And number two, I go back to, interest rates. We had a call this morning on cap rates. What does that look like? And there is a relationship between where interest rates are and where they might go and the value of real estate. So we really view real estate as location, what you're doing, what the project is it a growing area, is it a declining area? It's not a one size, it's not a top down kind of Soviet style one size fits all category. It's a category that depends a lot on where the location is, what the project is, what the economics of the project are, and ultimately, where you're able to finance that. and whether it's your home or whether it's a factory or an office building, what the economics are of those things. And it really is, it's not a one size fits all asset class for sure.
Yeah, and just like the stock market, there are always opportunities, right?
Yes, absolutely.
So, Anthony, to wrap up, in the interest of time, I just wanted to get your closing thoughts for the individual watching this who doesn't have any financial education, thanks to our school system, and doesn't really understand a lot of this stuff, doesn't know where to begin. What would you say to that person?
I thought a lot about this. I think the best book ever written for retail investors, and it's a little outdated, you can still get it on Amazon, was a book written by Peter Lynch called One Up on Wall Street. And it really explained and articulated investing to the investor. And I'll go back. Peter Lynch ran the Fidelity Magellan Mutual Fund for many years and was considered at the time he retired as the finest mutual fund manager ever. And I would get a copy of One Up on Wall Street, and I would take the opportunity to peruse that, because many of his lessons apply today that applied in that book when he wrote it 30 years ago. And secondarily, I would try and get my hands on the annual reports of the Berkshire Hathaway company. For years, I went to
That's Warren Buffett's company.
Warren Buffett. Yeah, for years I went to Omaha, and you can actually buy books of his essays from his annual meeting. And he writes a letter each year on investing and what you should own and what you shouldn't own and why. And it really is the best teaching product for retail investors, for institutional investors in the world, if you took the last 30 or 40 years of his letters. So there's really twofold. It's a twofold answer. I love Peter Lynch's book, One Up on Wall Street, and I love Warren Buffett's annual report letters every year. They really help you understand why you want to own certain things, what a true investor is. Listen, investing is about doing sensible things at sensible prices. And and understanding that we're going to have short-term volatility, but in the long term, this business is a weighing business that weighs earnings and weighs success. And lastly, I want everybody to always, even when it's most difficult, to stay optimistic and stay thoughtful, but cautiously optimistic. And whatever crisis we're in, whatever administration we have, you're going to do very, very well betting on the future of this country and the people in this country, and should never lose sight of that, particularly in a point in time right now where it does look dark. We should look at the optimistic and more upbeat side for our investors, for you, for our families. We have young children or young families, and you're just getting started. This is the time to begin to start thinking to invest for them. And as we're older and we're nearing retirement, make sure we redouble our efforts with the businesses, the stocks and bonds and savings and cash, and make sure the things that we own, we're prepared for what comes next, not what's happened. So, John, I couldn't thank you enough for including me today and asking me questions, and just a sincere thank you and gratitude.
Oh, no, the thank you is to you. Thank you so much for your time. Just brilliant wisdom and incredible gems of wisdom and knowledge, and stuff that people could just take immediately and use. But I think, to end on what Anthony was saying is, I think it's just so important for people to get proactive. This is such an important subject, such an important topic for you and your family and your family's future. And it's not something to sit and wait on and just hope everything is going to work out. Hope is not an investment strategy. And sadly, too many people are thinking hope is going to get them through this. It won't. You need to get involved, and you need to get proactive. So with that, as I always say, it's never too late to start your journey to financial freedom and peace of mind. Your financial destiny is not a matter of chance. It's a matter of choice. It's your choice, and it's something to go out and get, not wait for. So with that, Anthony, thank you so much. We hope you'll come back and keep us updated on what you think's going on. And
we'd love to do it.
Awesome. Don't forget to hit subscribe, leave a comment. Love to hear from you. With that, all the best. Take care.
Thanks, John.
Thank you.